Most people think you need to be a genius to make money in the stock market. You need a finance degree. You need insider connections. You need to read charts that look like a heart monitor having a panic attack. But here's something strange. The man who ran the most successful mutual fund in the history of Wall Street, a man who turned every $1,000 invested with him into almost $28,000, says the exact opposite. He says the average person with zero finance background, sitting at home, walking through a mall, eating at a diner, already has an advantage over every fund manager in New York. How is that even possible? Stay with me, because by the end of this video, you're going to look at the world completely differently. Every store you walk into, every product you use, every boring business you've ignored your whole life, you're going to start seeing dollar signs. This is the story of Peter Lynch, and the simple, almost embarrassingly obvious system he used to find what he called 10 baggers. Stocks that don't just go up 10% or 50%, they go up 1,000%. 10 times your money, and some of them were sitting right in front of regular people the entire time. Let's get into it. Chapter 1. The Man Who Beat Wall Street Without a Crystal Ball. Peter Lynch wasn't born into money. There was no ticker tape above his cradle. His mother didn't ask about a stock dividend between contractions. In fact, most of his family distrusted the stock market completely. For good reason. They'd lived through the Great Depression. To them, the stock market wasn't an opportunity. It was a casino that ate people's life savings. Sound familiar? A lot of us grew up hearing the same thing. Don't touch the stock market, you'll lose everything. Money conversations in many households are built on fear, not understanding. But here's the twist. Lynch eventually took over a small, sleepy mutual fund called Fidelity Magellan. And over the next 13 years, he grew it from $18 million to over $14 billion. Not because he had some secret algorithm, not because he could predict the economy, because he believed something almost nobody on Wall Street believed. The everyday person already has the edge. What does that mean? Stick with me. Chapter 2. Why the experts are often the last to know. Here's a question for you. When was the last time you noticed a new restaurant chain blowing up in your city before it became famous? Or a product everyone in your office started buying? Or a brand your kids wouldn't stop talking about? You noticed it, months, sometimes years before any Wall Street analyst put it in a report. Lynch tells a story about a stock called Hanes. They created a brand of pantyhose called Legs, and they put it right next to the cash register at grocery stores, somewhere women shopped every single week. Lynch's own wife noticed this product flying off the shelves long before any institutional investor caught on. She told him about it. He researched the company, and it turned into one of his biggest winners. The professionals were too busy reading spreadsheets in office towers to ever set foot in a grocery store and notice what real people were actually buying. This is what Lynch calls the amateur's edge. Think about your own life right now. What do you do for work? What do you buy every week without thinking twice? What's the one brand your friends won't stop recommending? That information is valuable, more valuable than you realize. And it usually reaches Wall Street analysts months or even years after it reaches you. You are standing on information that fund managers in New York would pay thousands of dollars for, and you're sitting on it for free. Chapter 3. The Boring Name Secret. Now here's where it gets almost funny. Lynch says one of the biggest mistakes people make is assuming a great investment has to sound exciting. A flashy name. A futuristic-sounding tech company. Something you'd brag about at a dinner party. He says the opposite is true. He actually got excited when a company had a boring, even ridiculous name. There was a real company called Pep Boys. Manny, Mo, and Jack. Sounds like a comedy act, right? Nobody wants to tell their friends at a party. I just put money into Pep Boys. But that embarrassing name meant Wall Street ignored it for years, while the stock quietly climbed and climbed. Compare that to a company with a flashy, futuristic-sounding name. Everyone wants to talk about it at parties. Everyone piles in. The price gets pushed up before the company has even proven itself. By the time it sounds exciting, the easy money is usually already gone. So ask yourself, how many boring businesses have you walked past your entire life without a second thought? A car parts store, A company that processes grocery coupons? A business that literally cleans grease out of restaurant kitchens? Lynch found 10 baggers in companies exactly like this, because nobody else was even looking. Chapter 4. What actually makes a stock good? The 6 categories. Okay, so how do you actually tell if a company is worth your money instead of just guessing? Lynch broke every company down into 6 simple categories. Once you understand these, you'll never look at a stock the same way again. Slow growers. Big, old, slow-moving companies. Think utility companies. They're not exciting, but they're stable, and many pay you a dividend just for holding them. Stalwarts. Big, well-known names that grow steadily, maybe 10 to 12% a year. Think of the big household brands you already recognize. Not explosive, but dependable. Fast growers. Smaller, aggressive companies expanding 20 to 25% a year. This is where Lynch found many of his biggest winners. Small enough to still have massive room to grow. Cyclicals. Companies tied to the economy's ups and downs, like car manufacturers or airlines. Booming one year, crashing the next. Timing matters enormously here. Turnarounds, companies that were basically falling apart and are climbing back from the edge. Higher risk, but if you catch it right, the reward can be enormous. Asset plays, companies sitting on something valuable that the stock market hasn't noticed yet. Land, real estate, even cash sitting quietly in the bank. Here's the question Lynch says you should ask yourself before buying any stock. What category is this? And what can I realistically expect from it? A slow grower is never going to suddenly explode 1,000%. And a fast grower can come crashing down just as quickly as it rose. Knowing which type of company you actually own changes everything about how you should think about it and when you should sell it. Chapter 5. The most dangerous trap. Diversification. Now here's a term you've probably never heard before, and once you hear it, you'll never forget it. Lynch called it diversification. Yes, diversification. Not diversification. Diversification. This happens when a company is doing great in its main business. And then, instead of staying focused, it gets greedy and starts buying up totally unrelated businesses it knows nothing about. A toothpaste company suddenly buying an oil rig. A retail chain suddenly buying a chemical plant. It sounds smart on paper, diversifying their risk. But it almost always backfires. The leadership gets distracted, spends a fortune on a business they don't understand, and quietly destroys the value of the thing that was working in the first place. And here's the unsettling part. This doesn't just happen to companies, it happens to people too. How many times have you seen someone doing great in one area of their life? Let's say a steady, working financial habit. And then they get a little overconfident, and they jump into 5 new side hustles they know nothing about, spreading themselves so thin that they end up worse off than when they started. Lynch's advice: stick to what you understand, whether it's a company or your own financial decisions. Chapter 6. Why hot stocks are a trap. Quick question. Have you ever heard about a stock from a friend, an influencer, or even a stranger on social media who is practically shouting at you to buy it right now before you miss out? Lynch has a blunt warning about this. Avoid hot stocks in hot industries. Why? Because by the time something is famous enough that everyone is talking about it, the smart money has often already made its profit and is quietly looking for the exit while you're rushing in. He compares this to chasing the next big thing. People kept calling companies the next IBM or the next McDonald's. Almost none of them lived up to the hype. The label itself was often a warning sign, not a promise. This connects to something deeper about human psychology. We are wired to chase excitement and urgency. Our brain releases the same chemical rush from, I might miss out on something huge, whether it's a stock, a crypto coin, or a flash sale. But the calmest, most boring decisions, the ones that don't give you that dopamine spike, are very often the ones that actually build wealth over the long run. Chapter 7. The number nobody explains properly. P/E ratio. Now let's demystify one term that scares people away from investing more than almost anything else. The PE ratio, or price to earnings ratio. Here's the simplest way to understand it. Imagine the PE ratio as roughly how many years it would take for a company's profits to pay you back the price you paid for the stock, assuming profits stayed exactly the same. So if a company has a PE ratio of 10, that's like buying a small business that pays for itself in about 10 years through its profits. A PE ratio of 40 means you're paying a much higher price for the same dollar of profit. You're betting heavily on huge future growth to catch up to what you paid. Lynch's golden rule: be very cautious of extremely high PE ratios. History is full of companies that got so hyped up, their price flew far beyond what their actual profits justified. And when reality caught up, the stock came crashing back down to earth. It's the financial version of paying $500 for a t-shirt because everyone's talking about the brand, instead of asking what it's actually worth. Chapter 8: Insiders Don't Lie with Their Wallets. Here's a detail almost nobody talks about, and it's one of the simplest cheat codes Lynch ever revealed. Watch what the people inside the company are doing with their own money. If executives and insiders are buying large amounts of their own company's stock with their personal savings, Lynch says there's basically only one reason they'd do that. They believe the price is about to go up. Nobody risks their own paycheck for nothing. He even says, and this is a striking line, when insiders are buying aggressively, there are almost no recorded cases of that company going bankrupt within the next 6 months. Why? Because the people who know the company best, who see the real internal numbers before the public does, are putting their own money on the line. Compare that to a stock tip from a stranger online who has zero financial stake in whether you win or lose. Whose information would you trust more? Chapter 9: Building the Story. Lynch had one habit that separated him from almost every casual investor. Before buying any stock, he would force himself to explain the story of that company in a few simple sentences, like he was explaining it to a curious 12-year-old. Not technical jargon, not buzzwords, just plain language. This company makes X, they sell it to Y, their profits are growing because Z. If you can't explain why you own a stock in 2 or 3 simple sentences, Lynch says you probably shouldn't own it at all. It's going up is not a reason. Everyone's talking about it is not a reason. This single habit alone would have saved millions of people from buying into hype they didn't actually understand. Whether it was the dot-com bubble, certain crypto coins, or the latest can't-miss stock tip from a group chat. Chapter 10: The Mindset Shift. So let's bring this together. Peter Lynch didn't beat Wall Street with a supercomputer or insider access. He beat Wall Street by paying attention to ordinary life. The products people actually buy, the businesses people actually use, the patterns hiding in plain sight that nobody glamorous enough to be on TV ever bothered to notice. He turned grocery store aisles, donut shops, car parts stores, and pantyhose racks into some of the greatest investment discoveries in financial history. The lesson isn't go buy random stocks from things you see at the mall. The lesson is this: you already have more insight into the world around you than you give yourself credit for. The job isn't to predict the market. The job is to pay attention, do simple research, understand the story in plain language, and avoid the traps. The hype, the diversification, the chasing of hot trends everyone else is already chasing. Most people wait for someone else to tell them what's valuable. The people who actually build wealth are the ones who learn to trust and verify what they're already seeing with their own eyes. So the next time you're standing in line somewhere, looking at a product everyone's suddenly buying, don't just walk past it. Ask yourself one simple question: who's actually making money from this? And could I own a piece of it? That one habit, repeated over years, is how an ordinary person quietly built one of the greatest track records in the history of the stock market. If this gave you a new way of looking at the world around you, that's exactly the point. Money isn't about genius, it's about attention. Thanks for watching, and I'll see you in the next one.